Welcome, Portfolio Builder members. Today, our high risk, high return portfolio is now up 286% year to date, outperforming the S&P 500 10 times. We've had a pullback, and I would recommend going all in. Push those chips. We're set for some huge gains through the summer. A lot of important things to announce. No changes to any portfolio. As you know, if you're a paid member, we have 4 strategies. I'll be reviewing these in greater detail throughout the presentation. What we have to look forward to is a stock buyback market melt up dead ahead and trillions in new stimulus about to pass. The losses in Virginia governor race and a Senate seat in New Jersey have lit a fire under the Democrats' ass, and they are moving quickly. Biden Kamala's polls have hit record lows. I think something like 36% approval rating for Biden. They're in a state of total panic. And that makes our job easy because this is their last chance to pass big spending before the midterm elections next December. So it's a red hot buy trade alert. Now, there's some warnings to tell us otherwise that we're going to keep a close eye on. And so here's my list of lines in the sand to at least raise an eyebrow. This doesn't mean we're going to freak out if we can explain what could be causing potential moves. So first of all, Tesla going below 800 is a problem, and it's holding strong, okay, at 1118 today. Okay, we're going to be worried about ExxonMobil normally going below 64. Today it's at 60.7. We're going to talk about that. Not worried, extremely bullish. Never been more bullish on that position than we are right now. So we'll be possibly increasing that position next week. We'll talk about that more. DXY, that's the dollar against the euro. We're concerned if it goes above 94.50. It's currently screaming higher up at 96, but we can explain why that's so hot right now and why it's unlikely to continue. Probably the best single indicator outside of oil when it's not being artificially manipulated, which we'll talk about, would be emerging markets sinking below 48. And today it's trading way above that at 50.94. Okay, probably the single biggest risk to markets will be the interest rates rising with the TLT going below 140. Not a problem. TLT's up 1% today at 148.50. We have a pullback in oil, which we'll talk about at 78.21, our line in the sand. Again, if it's not being artificially suppressed, would be 75. China crackdowns, lockdowns, real estate bust, all that. Okay, if CNY goes above 6.6, we'll get worried, but their currency remains ultra strong at 6.3. Okay, so again, let's talk about this. DXY is above our critical zone, but why? Well, it's because one little country, Turkey, is letting their currency hyperinflate. Okay, so we can easily explain this. The Turkish lira has gone just insanity from 6 to 11.25 conversion rate against the dollar. So it's lost half its value just this year. Okay, we're seeing weakness in Japan, but they're getting ready to put stimulus into the economy. And so it's really funny. The countries with the most stimulus are having the strongest currency, which is counterintuitive. All right, why is oil down? Should we freak out? Or are we about to have an energy crisis that's never been seen before? I believe the energy crisis is on the verge, and that's going to develop into winter and escalate into next summer. So Biden and Secretary Xi of China had a meeting, and the meeting came off with an agreement to try to suppress energy prices. And so what did? They released their reserves. This is a very, very short-sighted move. The reality is we need to create a lot more oil production. And this administration, their first moves were to ban all federal leases, to shut down pipelines from Keystone, just anything possible to to aggravate the situation has been done. And so, yeah, this is a buy the dip moment. What would really get us worried about our position, at least in the very, very, very short temporary term, are lockdowns. Lockdowns definitely need to be considered. I don't think we're going to get a lockdown because they're in the US because they're extremely unpopular and the Democratic Party is really in shambles. So they are just pushing as much spending through as possible. And so I'm not so sure we're going to get that lockdown. I do think that Joe Manchin and Cinema are going to pass the Build Back Better plan, and then we're going to get a melt up here in the markets. But we need to keep a close eye out. We have trailed Europe. Austria just entered an insane 20-day severe lockdown, and they're making the medicine mandatory for the whole population. Germany's entering some partial lockdowns as well. So we're not going to worry about some of the tiny, tiny countries in Europe. But if we start seeing major economies locked down, definitely interesting. Now we're playing the big US oil companies, so we're primarily worried about US lockdowns. I don't think it's happening. What I see coming down the pipeline in 2022 will be surging energy prices and life-threatening food inflation globally. So we're positioned perfectly for this. Now, if the Fed wanted to fight this crisis, they would have to raise interest rates. Right now, the market's predicting they will do it next summer. I believe this will create an economic crisis and that it will unfold quickly if they try to raise rates. Now, you need to realize going from 0 to 0.5, from 0.5 to 1 may not seem like a whole lot of interest rates moving up. But you need to realize that is effectively 10 times the magnitude of raising interest rates from, let's say, 3% to 3.5%, compared to going from 0.5 to 1. Okay, so we're looking at the rate of change of interest rates and where borrowers have become addicted to the super cheap capital. So the Fed's trapped. Stocks, crypto, and commodities are likely to melt up all the way until I'm now thinking around June, with stimulus fueling the inflationary fire and hopefully jobs coming back online. So we'll take a better look at that. Now, what if I'm wrong? What if the Build Back Better plan is blocked by Joe Manchin? Well, the market could crash for 1 to 2 months maximum, in my opinion, before they would come to terms and pass a bill. It's looking like they will be able to push this through. Maybe some of the Build Back Better social benefits are stripped out so that there's not an increase in the deficit, but it looks like they will push this through. Failure to pass the budget is critical, though. It would result in another debt ceiling crisis. So think of the sell-off and the panic we had in September. It will be much more amplified if this is not passed. Now, Janet Yellen has extended the deadline. She says she can fund the government through December 15th. So we likely see volatility starting December 1st if there's no progress. So all eyes 100% on Joe Manchin now to see if they can pass this bill. He's the one holding it up. Failure to close a deal in November would likely cause a crash in December. And we're ready for that in Portfolio Builder because we own UVXY, which is a aggressive leverage bet on the VIX, which is just a fancy product that gives you out of the money short-term put options on the S&P 500, or it gives you that relative exposure. It's more complex than that. But this can go up 1,000% in a heartbeat. Last March, when the global lockdown occurred, and we predicted this for our members, made a lot of money on it, the VIX went screaming higher. We had a 30% sell-off, and this happened in less than a month. This product went up 1,100%. So if you had 10% of your money, you were not in a panic. Now you got to realize the first 2 weeks, you're probably negative with your long positions. But when the volatility went screaming higher and we had limit down days and complete and utter panic, boy, oh boy, that thing just screamed higher from a 300% return on March 9th, peaking out by March 21st with an 1,100% gain. So 10% does the trick. I'm going to likely increase our hedging next week in case Joe Manchin's going to get funny with the party. And we'll talk about this more later in the presentation. But get this, the market could fall 40% and still be above the February 2020 levels. Let that sink in. We could make at least a 2000% return in the next crash. So get excited. Don't be scared of crashes. We know what the government does in crashes. They rush more spending in, they drop rates, and they start printing money. So it's almost always a buy the dip and cash out your crash insurance moment in time. So now may be the best time ever if you're on a free trial or a new member to follow our high risk, high return and pro strategy. I like combining those two. We've had a sell-off in the main growth asset for the high risk portfolio and in the inflationary hedge. You really could not have a better entry if you're just getting started with our program. Now, my core prediction remains that we will have a slow motion, multi-year rotation out of growth stocks and into value. So that means watch out for your FANG and load up on the energy and banks. That's the general prediction. And it's going to be very slow motion. There's going to be plenty of volatility. Here's a review of the cycle I believe we're entering. So the recipe for the cycle that we're looking at is to crash the economy and then to respond by increasing deficit spending and suppressing interest rates on bonds. So we did it after the dot-com bust, we did it after the housing bust. And each time you ended up with doubling the deficit spending, you had interest rates on bonds below inflation, and it forces investors into, you got it, the energy companies. And so you get these massive, massive multi-year run-ups. The average span is about 5 years. We're in really year 1.5. So I anticipate us holding this position for about 3.5 years to hit the peak. We'll talk about what could change that opinion and when there may be some temporary volatility to worry about. In general, I don't think the Fed's going to get aggressive with rate hikes until after the midterm elections next December. So 2023 will be a very short window of opportunity to crush inflation and most likely do that very short term before the 2024 election. So that's the big picture we're looking at. Now, when this stimulus does pass, expect foreign stock markets to outperform the US and for that dollar to come right back down. We're going to look at the pro strategy to have a huge advantage in the coming 12 to 24 months with 2 ETFs in specific. EDC is emerging markets times 3 and EFO is Europe times 2. The ticker it plays is EFA. And we're looking for this to outperform our UPRO position, which is the S&P 500 times 3. And that's where we've been racking up our gains in the pro strategy with American stocks dominating. Now, here's a quick lesson down memory lane. Last December and February, we passed 2 stimulus packages, one with Trump for $1 trillion and one for $2 trillion with Biden. And the initial reaction was this: emerging markets outperform US markets 50%. Now, China's been doing a whole bunch of funny business, which we can discuss later, which has caused their stock market to go down. But don't be fooled. Their economy is dominating and is looking red hot for the next decade. Also expect interest rates to rise and a growth to value rotation to occur. I think this is going to happen more like February, March, before it creates problems. And that's actually what's really funny is the timing of the stimulus is very close to the last set of stimulus. And so at first we can see the yellow line, interest rates were rising all the way up until March, until they went parabolic. They just went straight up. And what happened? Energy companies went parabolic, and long duration growth assets did not like quickly moving interest rates. So we saw the tech stocks with the QQQ fall. And you also got that drop in Bitcoin at the same time. So that's exactly what I believe is on the precipice of repeating itself. And the catalyst will be passing the Build Back Better plan. So that's our big 10,000 foot overview. If you're on a free trial or an expired trial, I highly recommend you call John at 505-610-1334. So you can sign up and gain access to our membership area where you're going to have all of the strategies. And so here's what's really cool. When you do upgrade, you're going to get all 4 strategies, and you get our turnkey software package that automatically tells you how to invest your money. So you just crack in 100 grand to invest. It's going to automatically divide the total to invest by our unit cost and then multiply it by the ratio of shares. And that's how all of our members get the exact same return over any period of time, because we all follow a strict ratio of shares. Okay, very good. So we've got a lot of content to hop into. Let me pull up my key data slides. Now we're pretty boring over here. We don't look at charts as much. Primarily interested in fundamentals and what's going to create a significant change in the macroeconomics of the economy. And so, spoiler alert, the economy is just not changing that rapidly for us to get it hot and heavy every 10 seconds. So let's take a quick look at some of the comments. So some people are not happy that we've had a little bit of a pullback in the high risk return strategy, but keep in mind you've still quadrupled your money. So you can't hit home run massive gains and then not anticipate there will be some volatility. That's what comes with the turf. George says they passed the, yeah, in the House. Now it has to pass the Senate. Mike says, how much would the market go down to cash in our insurance? Well, it's all about what's causing the crash and what's going to stop the crash. And that's my specialty. So we'll worry about that when we get to that point in time, but there's no static figure for you on that. Eddie says, what would you sell in order to buy more NRGU? And when, well, wait for the trade alert, Eddie. As you know, I don't recommend going outside of the trade recommendations and going going wild on us. Just follow the trading plan. Mark says, when do I think tech will fall? Soon as interest rates rise. We'll talk about that. Petros says, what's your prediction on real estate? I think it's going to hit a short-term top. Well, I think it's going to hit a long-term top next year and fall as interest rates rise over the next 3 to 5 years. So I would be probably selling and then renting, and then wait for an epic crash similar to the 2008 crisis, and then buy up some real estate. So yeah, I think we're coming towards the top on that. All right, so yeah, everybody wants to know, what does it take to crash tech stocks? Good question. This chart right here answers that for us. So let's go ahead and zoom in. This is known as the yield curve. And so we have on the x-axis, or if you're looking left to right, we've got the duration of the debt, or how long the loan is to the US government. And so we go 1 month, 3 month, 1 year, and it goes all the way out to 30 years. On the y-axis, we have 0%, 0.5, 1, 1.5, 2, and 2.5. Now you go back 3 decades, you could buy a bond and make 15% a year, plus the bond appreciated. What a deal. Today, the interest rates are way below inflation. Arguably, true inflation's in the 10 to 20% range. And these suckers want to pay a 2% a year for 30 years. Give me a break. And that's why we're seeing this crazy, crazy bubbles forming. Is because if they allowed these interest rates to match inflation, it would crush everything. Stock market would collapse. We'd go into a Great Depression, and it would be probably really good for America overall, but that's not politically something that's ever going to happen, at least not in the short term. So let's look at the timeline when we passed stimulus and what happened to the yield curve. So right now, if we look at November of 2020, Pretty healthy yield curve right here in black. And then they passed some stimulus. Okay, and then by January in the green, you can see these long duration rates started to jump. That's what the long duration assets don't like. They don't want to see a big, fat, juicy interest rate on the 10, 20, and 30 year. That's what's going to essentially act like a black hole and suck up money and crush everything around it. Now, by March, we ended up creating that catalyst to crash tech and crypto. And note the huge jump. We got these interest rates to 2.3, 2.4. So I think that will do it again. Unless we have a red hot economic recovery via labor, then yeah, I think similar interest rates will do the trick once again. And the TLT hitting 140 represents exactly that orange spot. So where are we at today? We're nowhere near it. We have an inverted yield curve on the 20 and the 30 year, which I'm not making too much of. We've got this funky shape right here on the 7 and 10. And then we've seen the 2-year jump. So we've got a flattening of the yield curve. Essentially, we've got problems ahead. Too much inflation, bond market's not happy. They believe the Fed will have to hike rates and that it's going to crash the economy. So we can see short-term rates going up, anticipating the federal funds rate going up, long-term rates going down, anticipating if they do that, it's going to be a total disaster and crash the economy. Sean says, for new money, do you recommend? I always recommend following the full unit and to build units out one at a time. I never recommend cherry picking part of the trading plan. It's a complex strategy where each position protects the other. So your growth positions are protecting you against this drawdown in NRGU currently. So always build out complete units. All right, so that's what we're looking at from the bond market. Now realize bond market's being suppressed by quantitative easing. And this is going to keep those rates lower than they normally would be. And we're now tapering. So by next June, we're supposed to stop manipulating these interest rates lower as we're about to pass more spending and ramp up debt issuance. Okay, next thing we're going to look at is where the market participants are hedging. And so to tell that, you want to look at visually where the dots jump the most. And so that's going to tell you where there's the greatest level of hedging. And so right now the market's predicting potential problems, primarily in December, less so in January, and not a whole lot into summer. Now, why? Well, it's because they got to pass these budgets. Otherwise, we're going to fail to increase the debt ceiling, and that is a catastrophic event should it occur. So we were much more worried about this when it didn't look like there was a political problem for the Democratic Party. They lost Virginia. That was telling. And the second they did that, it was instant action. Bills are getting passed. People are looking the other way. Jayapal from the progressives are becoming less aggressive with their demands and meeting Joe Manchin in the middle. So I do think they will pass a deal here. So that's my outlook for politics. Okay, reverse repo. Dang, what a jump. This was at 1.3, I think, yesterday or the day before. Jumped to $1.5 trillion. This tells us two things. One, low risk of interest rates spiraling out of control while reverse repos at this level. Two, tons of money in banks ready to be spent in the economy. So reverse repo readings are bullish for primarily our growth stock positions and our crypto positions, because our main concern is interest rates go up, and people run out of money. And this is a real-time feed telling us that. Now, what is reverse repo? That's when banks say, you know what, I don't like the interest rates I can earn buying T-bills in the open market, which I need to pay interest on all the deposits in my bank. So I'm going to go to the Fed, who's been gobbling up all of our treasury bond issuance, and borrow those so that I can get a decent interest rate to make interest payments on all the deposits in my bank. Okay, so it's a good thing. All right, let's take a look at the two main asset classes. So we really look at the markets as growth and value, and we like to combine the two. Okay, so in the gray line, we can see interest rates falling and your energy is going down. Interest rates go back up, green goes screaming higher, interest rates come down, green comes down. So NRGU is your way to make money if interest rates go up, very simply put. If interest rates go down, the NASDAQ tends to go rocketing higher. So my next trade alert most likely will be to, guess what, sell the NASDAQ and buy the NRGU. I think we could be starting to rotate some money next week, Eddie. So that's what I would sell and getting ready to do that. We'll probably let loose a little bit of our NASDAQ, beef up the UVXY. It's too low right now. If something unpredictable occurs, again, I don't see a black swan event on the horizon, but that's what black swan events are, unpredictable events. Now we can react very, very quickly. And we need to remember there's limit down features in the stock market. So we're not going to miss out on the big crash if we don't have a huge UVXY position before something cataclysmic begins. But I believe the bill's going to pass, interest rates are going to rocket higher, and you're going to get just massive gain on NRGU. People want to know how high I think NRGU could go. 600 to 900. That's where I think we're going to hit. Probably start some aggressive profit taking on our end. And right now, today, it's at 150. George says he's feeling good about gold and silver. Yeah, maybe. I'm not so sure. We'll see. We'll talk about that. Okay, Russell 2000 is IWM. This is what Stanley Druckenmiller, one of the hotshot hedge funds of our times, probably one of the best, looks at to predict markets, or one of his indicators. And after a year of trading sideways, it jumped. It's predicting higher. Okay, emerging markets. What's China been up to? Well, they've been essentially trying to improve their economy by taking a step back for a leap forward. Well, let's just leave it at that. Without getting too complex, I believe emerging markets is going to scream higher and is probably the best deal in the market today if you want to be long equities. This is Ray Dalio's favorite position, who, if you don't know, is one of the greatest hedge fund managers in history, who's made more profit for investors than anyone else, period. No one's come even close in terms of total profit. Maybe not the highest return, but that's not why people go to Ray Dalio. They want safe, consistent profits with low risk. All right, EFO is our Europe play plus Japan. Japan's introduced, I think it's a $500 billion stimulus deal, very good. And this one's loaded up in banks. So this is really set for interest rates to rise. Great play for how we're looking at markets over the next, really, I think it's going to be about a 3 to 5 year move in this growth to value. All right, what about the GBTC, ETHE? These two are trading very correlated since June. And Bootcamp Core, we're big on GBTC. In high risk, we're big on ETHE. And that has not changed. I think this is going to melt up into summer, and that the only critical risk is going to primarily be interest rates going up. Deficit spending, check mark. Democrats are going to push that through. That's the main thing we want to make sure of. If the Fed hikes rates, that will likely crash this space and everything else. So will they do that? Will the Fed have the balls to hike rates right ahead of the midterm elections? I call BS. Maybe one rate hike. Highly doubt they do more than that, because again, it would be politically disastrous. And I do believe that essentially the people who hate interest rates going up do control much of the government, which is the big tech monopolies. So I find that very, very unlikely to occur and remain super bullish. Now, the infrastructure bill, which was passed, has some language that's problematic. Okay, so they want you to do KYC on anyone you're doing any kind of transaction with. And so proof of stake can't do that. That's what Ethereum's switching over to. They did seem to make, I believe, an adaptation that's okay for proof of work, which is what Bitcoin uses. And so DeFi, big problems. This whole idea of doing proof of stake nodes, problematic. And places like Uniswap, problematic. So the House of Representatives do have a new bill getting pushed through right now to overwrite the current terminology, and we're going to keep a very, very close eye on that. But yeah, that's the biggest piece of news that has been negative. And again, buy the dip, buy the dip. Okay, if we believe governments are going to spend money they don't have and suppress interest rates on bonds to keep the economy trucking along, I'm going to be really bullish in this space and have been for much of my investing career. It's been extremely profitable for me personally. And I do think it's going to take decades, not years, but decades for this space to mature and hit peak pricing. Okay, so look at this, gold and silver finally doing something. We have in AGQ since October a 30% gain. You got a 4% position approximately in Pro and AGQ, and UGL's up 14%. You got about an 8% position in the Safe Alpha. So those are starting to look better. They're not going to like one thing. These guys are not going to like labor markets recovering. The OSHA mandate would have been a blessing for gold and silver, but it got shot down by the Fifth Circuit courts. So that's good news for labor and great news for NRGU. Not the best news for gold and silver. I believe to see gold and silver really shine, we need to come in with less than 700,000 jobs, probably less than 500,000 jobs consistently next year. So could that happen? Probably. But yeah, I would say if you want to predict gold and silver, focus on labor recovery. Below 500,000 jobs, good. Above that, really bad. And you're going to see your NRGU position go up. I'm much more bullish on NRGU in the short term than gold and silver. Okay, if we're going to crash, what products do we like? We like UVXY, which has been just the most punishing asset to own. We like treasuries if we're going to have a debt ceiling crisis. Okay, a shortage of treasuries could occur if we have a short-term debt ceiling crisis. It'll be very short-term. And then the dollar, a safe place to park cash if we're worried about volatility. So I'm willing to increase UVXY next week and NRGU next week, and that's it. And we'll sell our growth assets that are hitting all-time highs to accomplish that most likely. All right, in Bootcamp Core, we have some fun plays that are looking at hot markets of the future. So we have FNGU, that's like the triple Q, but it's only 12 tech companies. It's focusing on those FANG stocks that get massive, massive call option buying, gamma squeezes, all that jazz. It kicks triple Q's butt in most circumstances, but it has two Chinese giants that have had problems. Alibaba and Baidu. Long term, I love Alibaba. I'm not an expert at Baidu. That is China's, was their search engine. Now supposedly it's moving into AI and autonomous driving. So we'll see more about Baidu. But Alibaba fell 10% yesterday with disappointing earnings. Now, is China just going to let their economy collapse, or are they getting ready to print? I believe they're going to have to increase credit in their economy to stabilize their real estate markets, which has been crashing as the US is going to slow down its spending into 2022. We've got a new one on the board, which I haven't issued a trade alert for, KRBN, that is the carbon credits. Now, if we get a bunch of Republicans, especially populists, taking over the branches of government in the midterms, which looks like they will, I'm not so bullish on that one, but Long term, as long as you got globalist agendas underway, focusing on climate change and getting carbon emissions down, I think that's a play we want to get into. Solar's been dominating the clean energy race so far. We got TAN for that. And then we have rare earth metals, REMX. I'm bullish on that regardless of who's in power, populists, globalists, Republicans, Democrats, I don't care. We are going to have an epic shortage of lithium and cobalt in the next 5 years, and your play on that is REMX. This one's going up unless we go into some sort of depression and stop spending money at the government level. The other metal that we need a lot more of, that there's going to certainly be a shortage of, is copper with COPX. And if we are going to get carbon emissions down, assuming that is a globally agreed upon policy, the only way you really do it is with nuclear power. And so URA, uranium's the way you get that one. Nice sell off. I'll likely get us a bigger position in a bunch of these next week. And then the other play is MJ. So MJ's just been really boring. That, but it's usually boring and then just takes off to the horse races. So we started to get some bids on that. Let's just look at that chart. I'm not ready to kill it yet in boot camp, but you can see it's typically just a disaster and then skyrockets up out of nowhere, typically on stock promoters. So we're being patient here. We had a little bit of a run up and then it's just tanked again. So keeping a close eye on that one. So I do think we will have a trade alert next week. It's been smart to hold back, but I believe that time is coming. All right, the dollar. Here's some currencies to compare against the dollar. Why is the dollar going up? Simple, the Turkish lira is just spiraling out of control. Should we buy the dip on the lira? I don't know. Interesting. As soon as that starts to pull back, I think we'll stop seeing this strong dollar. Every other currency is trading pretty flat with the dollar, so you can tell that's really where the weakness is. We can see a little bit of a devaluation in the Russian, not really, not a whole lot. Everything's pretty much trading in correlation. So I think it's really just Turkey. I know the South Korean won has been devaluing a bit. That's a huge export. Temporary problems that I believe with the global slowdown that I do believe will pick up with the stimulus. And once we get through this next wave of lockdowns, again, temporary problems for the economy. All right, is China gonna collapse? No, I don't think so. We definitely saw exports and imports fall month over month, but they're still at record levels. Their e-commerce giant Alibaba has been having a very rough year. It's now back at the low where we heard Charlie Munger was doubling down. Will he quadruple down? We'll see. But yeah, long-term love Alibaba. Does show the weakness in China currently though. But again, their key indexes are not cratering and their currency is not cratering. So at this point, not alarmed by China's slowdown, which I believe is self-inflicted. Okay, probably a killer by the dip. I really don't care how low NRGU goes. I believe this is headed to 600 to 900, and I don't want you to miss those massive gains. So we will build into this position into winter and hope there's more weakness. There might be, but there very well may not be. People could likely start front running the expected energy crisis that's going to develop this summer. Oil could very well go towards 120, I think, by summer. Now, there's been some outrageous predictions of 200 or 300. Let's not get greedy. If we get to 120, that will make us a ton of money with NRGU. Okay, the spending's coming through. We're going to be reopening. We've now got Bill Gates coming out saying the vaccine, excuse me, hopefully we're not going to get banned for saying that. He's saying the medicine sucks, doesn't work as well as it should have. We did a terrible job rolling it out. Only China, New Zealand, and Australia have their act together with draconian lockdowns. and that it's going to be less deadly than the flu by summer. So I think they are basically saying we're losing the political war. No one's buying this anymore and possibly giving up on it. Maybe. We're still seeing some pretty crazy policies beta tested in Europe to see if they can get away with it here in the US, I think. So keeping a close eye on that. Now he's all about the climate change, and so he's lost interest in this for now. He's also been warning of a new contagion that's going to be released in airports. So that's the rumor mongering and conspiracy tinfoil hat that's spreading now. So again, we were on top of the lockdowns from January of last year, predicted it. Everyone thought I was totally crazy because the market kept going up until it collapsed. And again, if there's a crash, we're going to make you some money. So just don't worry about it. All right, in the top leaderboard here, we have a private equity offering that makes a lot of sense. If you want a sophisticated, advanced, and even more aggressive strategy in this space, it makes a lot of sense to hedge your Ethereum by owning its competitors, which are Solana, Cardano, and Polkadot. They are such better, and Binance for that matter. When I tried to do some personal investing in Ethereum or some yield farming and all that, to move things around is costing 30 to 50 bucks to set up some of these smart contracts costing hundreds of dollars. What the hell? It doesn't make any sense. Okay, so people are essentially too scared to sell their positions or move money around because it's so expensive. Meanwhile, I can go to Binance with PancakeSwap, and soon we're going to have Sunday Swap for Cardano's coming in. I'm tracking all of this for the competitors, but they're letting you move money around and set up smart contracts for pennies or sometimes dollars. But again, just much more efficient. And so I do believe that will greatly outperform. Now, Ethereum's anticipating proof of stake by next year. So that would be a good move for them, and we'll see what kind of impact that has on its competitors. But Solana, Cardano, Polkadot are your hedge for Ethereum, and that's definitely something we can do for you in our private equity offering. Okay, so great, let's go ahead. Okay, so are we gonna have problems in the healthcare system this winter? Whew, we very well likely could. Do we care for markets? Okay, so yeah, there's definitely been a correlation to the rise of the sickness and the price of oil. Okay, again, I believe we should be building into weakness this winter, not freaking out and selling. Vermont and Massachusetts are two of the most medicine states, and they're having record cases. Okay, so yeah, I think we're gonna have overloaded hospital system starting in December. Will it cause lockdowns? That I don't think so, unless we can't pass the budget. And I now think we will pass the budget because ratings are tanking for the Democratic Party across the board. So I don't think there's political willpower. We have Bill Gates kind of coming out publicly down talking all this. So it looks like they are pivoting their objectives currently. Oh, Morris has a great point. Says Turkey owns the Evergrande debt, so that collapsed. They lost a lot of money on that. Good point. Okay, Germany is, well, first of all, Austria went into 20-day lockdown, forced medicine for the whole population. What the heck is going on here? Especially when it's now super obvious this medicine just doesn't do the trick. Germany, record cases. They are now doing lockdowns in pieces of Germany. They're following Austria, which began with locking down the non-medicine population, but then they went and locked them all down. There's actually greater transfection amongst the people who've taken the medicine after 90 days. So very, very interesting. So we'll see how this plays out. I'm keeping a really, really close eye on all of this, as you know. Now, we did predict that the cases would fall and start rising. And boom, here you go. That's exactly what's occurring right now. So this is going to go up all the way till probably, let's say, January 1st, and then peak and come back down. That's what I believe is on the horizon. And we're going to see people catching all sorts of sicknesses, not just the one that's been hyped up. Okay, you go kill everyone's immune system for a year and then suddenly reopen and throw some random untested quote unquote science at the global population recipe for a disaster. So we'll see just how bad this gets. But again, short term, it's over by February. Buy the dip, add to your position in oil, because we're going to have a crisis by next summer. Okay, and releasing the strategic oil reserve is the stupidest thing you could possibly do right now, when the real demand is going to be in March onward. So that's my 2 cents on that play. Okay, seasonality. Here you got the seasonality. So it peaks at the peak of January 9th. Okay, I bet you that's pretty close to where we peak out this time too. So if we're lucky and we get a further pullback in NRGU, we would anticipate probably a bottom at mid-January. I'm not so sure we're going to get that lucky, but if we do, I would just buy, and get the maximum position we're willing to hold by January 10th. Sean says, did they release the SPR already? Well, they announced yeah, they have started that. It's a slow process. A lot of those reserves are hard to get to. I'm not an expert at it, but the market immediately responded to that, and we get this sell-off that was significant, but again, manipulated and short-sighted. Okay, how do we call a top in NRGU? 2 ways. One, we're going to watch DXY fall to 90 to 89, which I believe will occur at some point next year. And then we're going to watch, and again, this is a short term. ExxonMobil, I believe we could see it hit probably 80 by next summer, and I don't think we'll see it break to new highs for a couple years. So it's a very long-term play, and you can just see these energy companies can go parabolic. Are they volatile? Sure. Look at some of the volatility from 2010 to 2014. Okay, you go from 88, crash all the way to 68, probably think it's the end of the world, only to turn around and rip all the way up to its all-time high of 104. So it's going to be volatile. Think long-term. Is demand for oil going up or down? And is production going to rocket up? Well, the production's not going to rocket up. OPEC won't do it, and the US won't do it. The only thing we've done is allow 10 giant oil companies to have a monopoly on their existing sources of oil. And so NRG is a beautiful play here. Okay, here we have the triple T and US oil. So I was telling you that either rates go up or oil goes down. I was thinking the rates would go up first, but that's not what's happened. We've had oil fall a bit. Again, government does not want inflation. That makes it so they shouldn't be spending money, which is their favorite thing to do. And again, they're also suppressing these yields. But what's about to happen? We're about to get through this wave of lockdowns. We're about to completely reopen the economy. We're about to bring more and more jobs online. We're going to have less and less problems of the sickness next year relative to this year. And we're going to stop suppressing rates as much. So I believe the rates rise and oil keeps on going higher. That this is a very short-term sell-off. But you can see just how correlated these can be and how much of a disagreement they've had here since June or May. Okay, let's look at some other indicators. We've got copper futures stabilizing. Wait till China starts increasing credit. I believe this is going to go higher. We had the huge sell-off in lumber, and after this massive run-up, so we can see the inflationary spikes are hitting one asset at a time. So we saw lumber just go parabolic, then crash. But look what's happening. It's rebounding right back up now, and it's at record levels that have never been here in history. They're probably never coming back down to levels we saw before 2020. Natural gas goes parabolic, and we're about to have potentially one of the coldest winters recorded. So yeah, governments are freaking out that there's going to be an energy crisis this winter, not next summer. They're worried it's going to happen this winter. Okay, Baltic Dry Index fell. This cost to ship commodities around. That's in general good, but you can see it's still at record levels. It's still more expensive today than ever before in history, despite this pullback. I anticipate this will stabilize and remain expensive here on out. Okay, here's that jump in the 2-year. That's signaling that the Fed's probably going to try to hike rates. And this is anticipated to occur next July after they finish tapering in June. To get there, we need strong labor recovery, over 500,000 jobs a month here on out. And ideally, I think you're going to need to see 700,000 plus jobs a month, at least every 3 months. Gold to copper ratio just shows you how punished you can get if you bet on gold at the wrong time and bet against the reflation trade. Right now, I'm more in the reflation trade camp. That means we want to be betting on these products that are used to operate the economy. So we like copper, we like lithium, we like oil. So we like COPX for copper, RAMX for lithium, and then we like NRGU for oil. And I believe those are going to go significantly higher next year. Okay, bond markets we pay close attention to are TLT, JNK, LQD. If any one of these three are falling quickly, we have credit issues and no access to capital for either corporations or the government, and you're going to have problems. So right now, they've been trading flat or up, nothing to get concerned about, and that's been since April. Janet Yellen's getting ready to issue some more debt as soon as they can pass the reconciliation bill, which is being labeled the Build Back Better bill, or they're going to pass that through reconciliation. That's going to expand the debt ceiling, and we're going to start seeing a lot more debt issuance. And that's how we're positioned. We want to see the debt piled on. Non-farm payrolls came in decently. They did revise these two up big time, big time. So these are the kind of prints. They probably underreported it to protect rates from going up. How funny that they would want to underreport jobs to protect the tech giants. So in general, I believe we're going to see rate hikes if they can be bobbling 700,000 average jobs per month from now through summer. Under that, they may have to delay it. And if you get some more prints like this, then they're certainly going to hike rates, and we're going to have a big problem in financial markets. So yeah, the government doesn't want jobs to come back. Okay, here we have core inflation. We predicted it would go up. I think it's going to trade above 4 for quite some time and continue to cause pain on the poor. And again, this is going to be a political sticky point for the midterms. There's going to be a lot of pressure to try to get this inflation down. Catches, you're going to kill the labor recovery if you hike rates too soon. Banks are loaning out money. That's how we're positioned. If we thought there's a deflationary crash, we'd want to see this falling, not rising. Consumers are growing their credit card balances, bullish. Retail sales jumped 1.7, bullish. Consumer spending is at record levels, bullish, although flatlining as long as it doesn't fall. Job openings slowly falling. Producer prices remain ultra hot, no signs of a slowdown in the inflation. Jobless claims are flatlined, but not rising. That's good. The wage pressures continue to build in both of those charts. Now, here's what we need to realize. We should be hitting 63 labor force participation right now. So if we didn't have a global lockdown and we kept the Trump policies intact, we were on track to have a 8-year run up in labor, which would have been great for your average American. But instead, we locked the world down, and now we're flatlining way below 4 to 5 million jobs below where we were. And again, where we were on track to be is more like 6 to 7 million jobs behind. So we really, really need to get the labor recovering if we're going to slow down the government spending. And there's definitely going to be a massive fiscal cliff approaching by next summer. So we got to get these jobs back online, or there's going to be problems in the economy. Okay, balance of trade hits a new record low. Bad for the dollar, how we're positioned. Income is down 1%. Apple breaks to a new high, I think, on their EV headlines. Yeah, probably time to rebalance tech into growth here, or excuse me, growth into value here in the soon. Tesla stabilized. This is a canary in the coal mine. If it goes below 800, we will expect some systemic selling. ARK funds, way oversubscribed for what I believe is coming at us, which is rising interest rates. I could potentially see us buying this down in the 30 to 50 range after it gets clobbered as rates rise over several years. So no immediate trade alert there. Some big tech giants in China, Tencent looking good. Alibaba, another big dump. Not worried about it long term, but keeping a close eye on it for signs of a bigger problem. So it's definitely remaining weaker longer than I anticipated, but I think that is going to come to an end soon. Samsung still weak, but not crashing. Toyota at a new high. So no reason to get super afraid. We've got China's PMI stabilizing above 50. We've got the European PMI still way above 50 in growth territory. Now, here's probably the biggest warning sign in the entire global economy is to see Chinese imports drop, but it's been dropping and going up, dropping and going up. Big picture, it's way above the imports it's ever had. So strong economy in China, which is a measurement of global demand. Tiny drop in exports, not a lot. So if these were to free fall, we would get much more concerned. Okay, let's look at some balance sheets. So the Fed hit a new high, $8.6794 trillion. Stock market's been highly correlated to balance sheets. And Europe, another big print. So they're still suppressing rates, forcing investors into everything except bonds and currencies. Okay, let's check out our news feed. Jim Bonko's saying, hey, everything's picking back up. We're anticipating this. I believe it's a buy the dip. Austria going into a nationwide lockdown for 20 days. Here's a chart showing oil relative to sickness. Okay, so we want to build into any weakness this winter, anticipating we will peak at January 8th. Andy Duran says, worth noting that when and if paid leave, 200 billion, and or immigration, 100 billion, fall out of the bill in the Senate, the deficit figure will evaporate, and then Joe Manchin can pass this through. So I think that's probably what's about to happen. We just looked at what's happening in Germany. Peter Schiff says, Democrats claim giving American workers 4 weeks paid vacation will only cost 200 billion over 10 years, as they assume only those Americans with real need will take time off. But if all 150 million eligible workers take leave, it'll cost 4.5 trillion. Okay, that's great for us. We You know, the more debt we build up, the better our assets do. Jim Bianco, bond bearishness has been a constant for decades and horribly wrong for decades. And to be clear, I'm a bond bull long term. I just think we have a couple year problem ahead before we hit peak interest rates. German producer price inflation hits 18%. So why not lock down and cool off the inflation? Why not? Oil prices are finally falling thanks to China and Joe Biden, CNN Business. Okay, temporary fix. Used car prices still rocketing higher. Yeah, the inflation problem's just not done. Here's a comparison of drug problems in the US before we outsourced all our jobs to China. So you can see just catastrophic economic consequences of outsourcing our labor abroad. It's been horrible for the average American. Great for corporations. Just some data showing, this is, I believe, out of the UK. The medicine's not stopping the spread. And it looks like it's also not helping hospitalizations or deaths. The main producer of the medicine just came and updated the trial they did, and they had hidden 6 mortalities. So there were more people that died using the medicine than not. It's just absolute insanity. Here's some predicting oil would fall from 81 to 62, and then someone comments, well, for perspective, the year before they thought it would go from 53 to 42, and here we are hitting 80. George says, how come used cars are going up so much? Chip shortage, money printing, supply chain issues. Excess mortality globally is up significantly, probably because the effects of a lockdown and then just screwing up the whole healthcare system. So not making too much of that. Now they're starting to talk about lockdowns for climate change. We're seeing Powell criticized by the Senate for not being a climate activist. Good old Bill Gates donated $320 million to media. He can have his little speeches here and there. Again, he's pivoting for sure. Here he says dip below seasonal flu levels by mid-22. Ireland back into lockdown with 93% taking the medicine. Again, why is oil down? They're releasing the reserves. Is that a real fix? No. Trucking rates are rising rapidly. $500 billion stimulus in Japan. Okay, good. That's the key highlights. We're going to review our positioning. But I need to do a quick little closeout for the part of the video we remarket. This is where the video ends if you're not a paid member. So call John. We're going to do a trade alert next week. You don't want to miss it. 505-610-1334. He'll get you upgraded and get you into the private membership area. There's our disclaimer if you want to pause it and read it. Have fun with that. We're going to go ahead and close the remarketing video and jump into paid member only content now.